Anne, and I'm part of the Vancouver Startup Week team. Before we begin, I just want to take a moment to acknowledge that we're grateful to be virtually gathered on Indigenous land, regardless of where you're joining us from. I'm grateful to be on the traditional, ancestral, and unceded territory of the Musqueam, Tsleil-Waututh, and Squamish peoples, where I'm privileged to live, work, and play on these lands. I want to thank you all for joining us for VSW 2021, and welcome to today's session, Frothy and Hot. Does that describe your coffee or the current investment market? Hosted by Angel Forum Vancouver. If you have any questions for our speakers, please be sure to use the Q&A section on the Whova platform. You can also upvote your questions to make sure that they're asked. Without further ado, I'll pass the mic over to my speakers and we'll begin the session.
Thank you so much for this warm welcome. Welcome everyone. My name is Irene Dorsman. I'm involved with the Angel Forum here in Vancouver, and I want to extend a very warm welcome to all those nice people that have agreed to join us today, because they have a lot to say about the frothy and hotness of the market or the coffee. I have my coffee here, so I'm going to focus on my coffee for now. I'm going to hand it over to Peter, who will just briefly talk about the market and what we did see happen, sort of start to happen, I think about 6 months ago, right, Peter?
Okay, yeah, thanks, Irene. I will take you through a short presentation, and then we move to, well, let me just start here with the screen. And yeah, so Angel Forum, so what we do is we connect high quality tech companies with funders, with investors. We provide educational workshops, and we build a community, and we've been doing that for many years. And Irene and I took over about 2 years ago, and we've been very active, in particular over the last, I would say, 15 months that we're in sort of lockdown and working from home. We've concluded quite a number of deals and invested in quite a number of deals across BC and Canada. So helped in that by Harper Gray, TMX, PwC, OKR, Financial, Apply, Virtual CFO, and Nimbus Energies, names you will recognize, and they've been true and loyal sponsors. So what are we talking about today? So I'm going to give you a quick introduction of what's happening in the market, the financing market for early stage, for starting up companies. Then Harper Gray will dive a bit deeper. Prentice will talk a bit more about SAFES, which is a structure of financing early stage companies that has gained some real momentum over the last year and a bit. And then we'll have a panel discussion to talk with some other investors from across the province, and to get a bit of a read of where things are and how they see the market, and if they view it as a positive or a negative, etc., etc. And it'll be very interesting, because I know all of these people that are on the panel are active deal makers. So good stuff. So yeah, so a lot is happening in the market at the moment. The stock markets have been doing very well. Interest rates have been coming down, and we've seen lots of announcements like every week. And if you look at the bottom of my screen, it says the first quarter saw a record level of Canadian venture capital financings. That came out this morning. This is screenshotted from the Globe and Mail. I know that William Johnson ran it as well. It's big. It's about $3 billion that went into the Canadian tech scene first quarter. So that's a record number, and we have not seen that before. Last week we had Doody saying they raised $80 million in the Series B round. Like only last year, I would say a year and a bit ago, they were at Angel Forum, with a pre-money $6 million valuation, and a year later, look at what they're doing. So something is clearly happening in the markets, and in order to sort of explain that, I wanted to sort of take two angles, like what are we seeing on the supply side, what is happening in technology, and then what is happening on the finance side, right? Because tech and finance come together, they build companies and finance companies, but they're two pieces of the puzzle. So there's a number of pre-existing trends that were always there, but I think they've really accelerated. We talk about agri-tech, we talk about health developments, we talk about automation. There's a lot happening right now in tech, and that keeps on growing. And therefore, I think it's not necessarily that we're in a bubble. I think there's a real explosion of new tech companies happening, coming out of universities, people starting on their own. And that disruption in technology, you see it across all sectors. Like I mentioned, agri-tech, I mentioned health, I mentioned clean tech, even all the way to sort of how food gets delivered, how you order certain things, how you organize the office. There's disruption happening everywhere. When I started investing and working with tech companies 20 years ago, it was B2B software, a bit of biotech and emerging internet. Now we see tech everywhere. And the cost to start is much lower. My first angel investment was in a company called Actinum, a software company based here in Vancouver. And we raised $1.4 million. This was in 2003 to build or finish building a piece of software. These days, you raise $1.4 million to commercialize a piece of software because investors will assume that you've already built it. You have a minimum viable product ready. It's a different market. It's easier to start. The resources are there. And all the money we'll raise will be used to build something that's already tested, that's viable. I've seen a lot of increase in the ages of founders. Right? I work together with a number of women who are in their 60s. They run tech companies. I see a lot of people in their 40s and 50s approaching us through Angel Forum or through eFund or other events saying, hey, I'm starting a company. I've done this all my life, but I've learned this. And I made some money and I want to do something new. So a reorientation of careers is creating a lot of new startups and a lot of new opportunities. And I think that that's certainly great news. And we're working remotely. We've always done it. It's just been accelerated. A dispersed workforce. I mean, you can run your company having your CTO sit in Halifax, your CEO in Vancouver, and your sales team could be dispersed all across Canada and North America. On top of that, the global outsourcing, I sit on 2 boards where we have development teams sitting in one in Slovakia and one in Serbia. Again, something that has gained a lot of traction over the last 15 months even further. And then the fact that we're sitting here, the growth of ecosystems, right? If you're an entrepreneur or an investor, you're not alone anymore. You can go to events, there's workshops, there is get-togethers, and there's tons of resources where you can learn how to build your company or how to invest better or connect with other investors. So a lot is happened in building ecosystems as well. So on the sort of supply side where companies are being built, where we see growth, there's an incredible amount of happening, and there's sort of a steady deal flow, steady pipeline of new companies coming out of all of these things. On the money side, what we've seen ever since the financial crisis in 2008, we've seen low interest rates, and we've seen incredibly proactive governments and monetary authorities sort of supporting the economies with lots of cash, tax breaks, you name it, right? So there's a lot of liquidity in the market, and ever since the pandemic hit about 15 months ago, even more so now. So it's all been sort of accelerated. And what I'd like to see and what I've seen is that what I call the mainstreaming of angel investing. So investing in startups was done by wealthy software people or biotech people or very wealthy high net worth people who've done very well. But now we see a trend where people who are not super wealthy are able to allocate a chunk of their portfolio away from public markets or real estate and put like smaller amounts in startups, either directly or through funds. Like we run eFund, we have, James has his fund, the syndicates in Victoria. Irene is part of the Women's Equity Lab, which now has chapters in Victoria, Vancouver, and starting in Kamloops, where people get together, they pool small amounts of capital, but if you pool a lot of small pieces of capital, you have a big pool and you can make investments. And that's a trend that I see all over Canada, and I see it in Europe, where I do quite a bit of business as well, where angels get together, or maybe not even angels, but people sort of who have a bit of money and want to get in technology. So a lot of money happening there. I don't want to spend too much time about the alternative market, about Bitcoin. We all know about it. It's driving some of us crazy, but it's creating more liquidity and more activity in an already sort of pretty exciting investment market. And then from a startup perspective, we're seeing a lot of exits. Companies are being built and they exit. They're being bought by a larger corporation, or they go to an IPO, or they merge. In a time when there's a lot of liquidity and interest rates are low, you see a lot of that activity. So if I put the tech trends and the finance trends together, what are we seeing? So healthy deal flow and lots of early stage financings. I mentioned it at Angel Forum. We've seen lots happening over the last year. I see a lot of rapid follow-on rounds. So companies that have done a financing, within a year, they're back for a follow-on round, often at a much higher valuation. I mentioned Dooley at the beginning. They did a small angel round last year. It was followed up with a Series A, Series B. I see it in our portfolio. I see a lot of companies, and James certainly can talk a little bit about all the companies in Victoria that have been doing very well, software companies. They come back to the market, they start with a first round, and then within a year and a half, they come back with more funding. And that's pretty exciting. It's good for companies. It enables them to sort of quickly ramp up and take advantage of the capital that's out there. But if there's a lot of money floating around and a lot of exciting opportunities, there's a chance that valuations go up and demand for some good deals is very high. So if there's supply is sometimes limited and there's a lot of money, prices will go up. And therefore, you see a lot of use of a lot of creative financing structures, such as SAFEs, a simple agreement for future equity, or a convertible loan. And Prentice will talk a little bit about that. I see a lot of cross-border activity, and by that I mean, angel or early stage financing rounds are increasingly done across provincial and global borders. So most deals that I was involved in had angel investors from the East, the Prairies, and Vancouver and Victoria. It was not necessarily the case 10, 15 years ago. That is really sort of ramped up. And in end of December, we closed a deal, an agri-tech deal here, Lucid Biosciences, and had a few investors from Europe in there. Angel investors who had never done a deal, who had never even looked at Canada, but they got excited about the opportunity. They took advantage of the relationships. So that is also a major trend. And what I see, what I like, I see a quick close of financings. Because there's a lot of demand, there's a lot happening, deals can get done pretty quickly. This is also the result of having well-organized ecosystems. 10, 15 years ago, people didn't know what they were doing. Now people are well educated on term sheets, on due diligence, on data rooms, and collaborating with where startups collaborate closely with the investors, helped by lawyers and accountants to do things quickly and build successful deals. And as I mentioned, sort of lots of exits, M&As, and IPOs. If interest rates are low, a large corporation can borrow significant amounts of money through which they can acquire earlier stage companies. And that's an exit for the angel investors, who then quickly recycle that money, or at least a chunk of that money, back into new investments. So it's a cycle of quickly recycling money through the ecosystem, and we're in the middle of a good time. So that is sort of my setting the stage. There's lots to talk about. So I think I want to hand it over to Prentice, who's going to talk about safes and convertible instruments and how they play into this hot and frothy market. And then, after he's done, we're going to go to the panel. So I'll stop sharing my screen, Prentice, and I'll let you take it from here.
I'll take it over for a minute. I just want to explain something about the thought that we had behind this session. So we've sort of described the market as we see it. What we've also seen, and what we just touched upon briefly by Peter, is that we have seen safes almost everywhere now. Like I would say the deals that we see, 80% is safes. Like I would say a year ago, that would be about 8%. So that was a big change. And we have a feeling that not everyone fully understand, and I mean on both sides, investors and founders, sort of the full safe. So we thought, like, we always like to throw in a little educational aspect. So we asked Prentice, and he luckily said, yes, I'm okay with doing that. So Prentice has a sort of the short but very important thing about safe. So Prentice, if you can share your screen.
Okay.
Then the stage is yours.
There we go.
Perfect.
Hi, everyone. Yeah, Irene, just do this if it's not working, please. I'll reconfigure.
You're good.
Yeah, thanks. Yeah, it's always a pleasure to be to join Irene and Peter and the other panelists and being involved with Vancouver Startup Week. I'm a partner at Harper Gray, local law firm here in Vancouver, one office, almost 90 lawyers, and I spent a lot of time in the tech space and worked with Irene and Peter quite a bit here. So let's just dive into this. I think I've got a few minutes anyway. So let's, what I really want to talk about are safes and what are these things? And then I thought I'd throw in, because this comes up all the time, is just how do we deal with the cap table? So when you sell a safe, you know, how do we deal with that when we get to the cap table stage? Because people always look. Let's start out with debt, because debt really is, I guess, a precursor in a way. You either get money into the company, but by debt or equity, and equity is buying the shares, and debt really comes in as a loan. But you've got to repay that loan, and it's usually on a term or on demand or something like that. And often there's a security interest. And why it's important is that if things go sideways and you as an investor want your money back, if you have loaned the money to the company and have granted a security and been granted a security interest, you know, you'll get your money out first before the equity. Okay. But, you know, that wasn't always sort of the idea. And as Peter's already described, you know, when things are moving quickly, you end up sort of coming up with a, well, how about I loan you some money and we might convert it into shares at a later time. So for several years, we were looking at this, and I'd actually line it up with the financial issues that happened in 2008, because a lot of companies, or I saw a lot of investors using the convertible debt instrument to bridge that gap, to protect their loans, to give the issuers a little more breathing room to survive another day. So, but what are they converted into? And so we often convert our debt into equity, but it could be existing or future equity. So, you know, existing common shares, for example, but maybe it's convertible into something new. And then we have to talk about pricing, you know, what price and who gets to choose when to convert. And often some questions around what will the future equity look like. And, you know, you'll hear terms like preferred shares, and Peter's already mentioned Series A or Series B. Often these loans are converted into that new equity or that new form of share that is created at some time in the future. And then, you know, when will those shares be issued? You know, when does the conversion occur? So I sort of just talk about the debt because it ended up morphing in the last several years into these strange new things, these new securities called safes. Peter explained the acronym, but it's a simple agreement for future equity. So we don't know necessarily what the new shares are going to look like, or what their rights are going to be, or anything really to do with them. It's just an instrument to get money into the company, and we'll settle things at some point in the future. You know, what are these things? Is it debt or equity? And this is an important part of this, because I just explained the two facets, you know, debt or equity, get the money in. Safes are somewhere in between. You lend the money, or you subscribe for a safe. You don't get a share right away. You just have this agreement to get another share in the future at some point. But it is debt-like because you can be repaid in an exit event. So you'll never actually have a share. You'll just get money back if there's a liquidity event. That's just it. But it's also equity-like because you don't have a right to be repaid. You don't get to demand repayment, and this just converts into shares at a more formal financing that takes shape. So safes are there's really a standard form that's been published, I guess, in the States by Y Combinator, and up here NACO we have you know, a Canadianized version of them, but it really is a standard form. There's really not too much negotiation that goes on with a safe. It's presented, you talk about it, but what is there to talk about? And there's really only a few features. And it's whether you have a valuation cap or not, and if so, what it might be. There's a discount rate usually attributed to your investment for the conversion into shares. And you can have a safe with both of those items, which is probably the most common. One or the other, a little less common, or neither a valuation cap or a discount rate. And I've got to say, I don't think I've actually seen that. So, but it is possible. You could just be silent on the discount rate and the valuation cap. So these are both both very important items to discuss, and that's really where the negotiation comes in. If you invest $100 in a safe and it's to convert it sometime in the future, usually as an incentive for you as an investor to write a check, you'll get a discount rate on the conversion. And in addition to that, there's this concept of the valuation cap, which is an important part, because if you raise money at a higher valuation than the cap provided in the safe, effectively you'll be issuing more shares than you would if there was no cap. So they're very interesting concepts, and you need to work it through, and we'll get there in a little bit in some more detail. So are they better than debt? I'd say that it depends, but one of the things about safes that's attractive for us here locally is we have these incentives, tax incentives pursuant to the Small Business Venture Capital Act. The general premise under that is local investing by local investors. You've got to be in BC really to take advantage of this. And the idea that you're going to invest in local tech, for example, for an extended period of time. And these are eligible for the EBC tax credits, which is effectively 30 cents on the dollar. And I think the last time we looked at this, when you subscribe for the SAFE, you actually are eligible to get your tax credits. So the timing's varied a little bit with the ministry, but I think that's where they're up to. At least that's the latest I've seen. So where I get a lot of questions about, oh, we have these safes, or we have this debt, and the investors are looking at my cap table, and how do I relay this information to make sure that it is fulsome? So where do they go? I mean, in short, debt doesn't belong on the cap table because it's debt, it's not equity, and cap tables are all about debt. But of course, the exception is if it's convertible. And if you had a convertible loan with fixed conversion terms, you could put a placeholder on your cap table to say, these are convertible into common shares at a certain price. And so you could reflect that because there's some certainty. You can also find a way to put the safes on, and the safes are an important part of your cap table because whether they convert actually into the shares on a financing or not, they will be entitled to proceeds of the liquidation event. And we stick these various things in the footnotes of the cap table, so we can describe sort of which class of shares they might be convertible into, what price per share, etc. So let's just look at a quick cap table here. Lots of moving parts, but the third line down is the angel line, and the angels have invested, and this is where we're going is when does a safe actually come in, and where would we put it in the cap table? But this is a pre-safe cap table. We haven't contemplated a safe yet. We've just raised a bunch of money from friends and families and some angels, and we know we're going to raise money in the future, but we really have no idea who it is or what we're going to sell. Is it going to be an A round? Or is it going to be more, perhaps more angels or something like that? But really just demonstrative purposes, and of course happy to share slides after. But I've just brought up on the left side here, if you can see my mouse, this arrow, and this is right around the spot between the angels, which we've got a fixed dollar amount and we've issued so many shares, but we haven't raised with for example, a venture capitalist or the next investor, and we don't have sort of finalized terms. So a safe's going to happen right after the angels and before this next investor. We've got some people that want to raise some money. We haven't settled on a valuation of the company. We know that we're going to do something in the future. How about a safe, and let's see where we go. So again, pre-series, we would put that, sorry, I've lost my arrow here, but that's going to go in here. And then down at the bottom, I've got just an asterisk. We'd probably describe the safes that would be included. So say, for example, we raised $1 million in safes or $500,000 in safes, and we would provide at the bottom of the cap table that there's a valuation cap or the discount rate. And that's really all there is to it. We still don't know what class of shares or the features of the shares that they'll be converted into, but that's how you just demonstrate it on the cap table. When we do get here, I've just labeled it venture capital A or Series A round, when that comes in, the safes will be included in here. That money that you've raised at, say you've raised $500,000 with the safe, that will actually become part of that 3 million shares that we're contemplating here. There are wrinkles. There are you'll hear about classes of shares and different series and different issue prices, and that sort of rolls into what the safe actually becomes. But in essence, that money, and here we've got a $1.5 million raise, that $500,000 on the safe would be included in this line once it's converted. Are they good or bad? This is the ultimate question. I think this is the growing debate, and I'm not sure what the right answer is. You need to run the numbers. You need to plan on dilution. I think whether it's good or bad depends on what you do with your cap table, and I would suggest it's not a matter of changing your actual cap table, but playing with it, inserting variables, and trying to think about things like, what if we raise money at a certain valuation? What would happen with this safe? What would it convert into? And that's where safes can ultimately maybe be more punitive to the founders than you might originally think. The problem is that, before we go there, the problem with raising the money, and this goes to Peter's comment about the frothiness of the market. The velocity of capital is faster probably than it's ever been, and especially in our little tech world here, people are deploying capital at a very fast rate. Companies want to accept capital more frequently than they have before. Peter's example of even within a year, a company is fundraising again. Problem is that parties can't agree on the valuation number, because if you could, you'd just subscribe for shares. So they really sort of push that off until the next financing round, but the money's waiting. So that's where a safe is really good, because you can raise money quickly and effectively on certain terms, but we just sort of are kicking the ball down the field a little bit until we have more certainty about how much money we're going to raise at what valuation of the company, and then we can, again, back to our cap table, fix those numbers. But to sort of crystal ball gaze, you need to look at your cap table, and you need to play with the valuations and what that valuation cap in your safe is going to, how it's going to affect the dilution. How much money are you going to raise via the safe, and then otherwise, and again, what are the impacts? And considering when you go into your, I typically use an Excel spreadsheet when I'm playing with these numbers. Play with the numbers, experiment. You're just on your laptop, you just sort of play with things and sort of outline what it might look like. At the end of the day, your investors are going to negotiate with you on these variables. But as a company, you want to have your homework done and understand what these changes might mean and how they might impact you going forward. So that's a quick rundown on safes and a little deeper dive. I hope that was helpful for all, but that's it for me.
Thank you very much, Prentice. One question which always comes up sort of from the angel investor side is that a safe sort of leaves the investor hanging. Can you speak to that?
Sure. I guess the thing is about it is there is this sort of limbo stage, as you say, leave them hanging. You don't know, it's not formalized until there's another financing that comes out. At that new financing, valuation is fixed, and the safe is eventually, converted or rolled into that new equity class. So in that sense, they are left hanging. But on the flip side, if there's a liquidity event in the meantime, you know, they'll get their money out pursuant to the standard form of the safe. So you are in limbo, you are left hanging until there's that next event, and you don't, as a safe holder, you don't have any particular rights to force that new financing. It's in the company's hands.
Thank you. I think thanks very much, Prentice. I think we can move on to the panel. Both Peter and I have questions. I'm toggling in between sort of the event platform and Zoom here to keep an eye on questions. But I would like to start with sort of introducing the panel to you. Well, of course, we have Prentice, who has just spoken, so thank you, Prentice. Then we have Maria Pacella. She's partner at Panda Ventures. Thanks very much for joining us. And I hope I may add that you're part of the Women's Equity Lab here in Vancouver too. Peter mentioned the chapter in Kamloops. I have to correct him there. It's the Okanagan as a whole. And we are working on opening chapters in Toronto and Winnipeg. So hopefully more about that. Thank you very much for being here, Maria. Then I go on to Christina. Christina, it's wonderful to see you again. Christina is a venture partner at Panda Fund as well. We're very lucky to have both of them here because I think they have lots to add to the discussion. And last but for sure not least, our friend James de Geef from Victoria. Welcome all of you. I'm going to ask one question and then Peter can hop in if he wants to. We've heard all this good news. It's great. There's lots of exits and whatsoever, but I'm pretty sure there's always ventures or people that do not benefit from the sort of the upswing that we see right now. Would you like to talk about that a little bit, Maria?
Sure. So yes, hard to say in this current market who's not benefiting actually. You know, I never thought I would, you know, not see valuations go down during a pandemic. So I don't know what other black swan event we need to see. I'm sure that's forthcoming. You know, I do think that good companies that are performing well, well-positioned, you know, it's a great time, still a great time, has been for quite some time to be raising money. I do think for the ones that certainly were a little earlier stage and maybe not in the most obvious recipients, beneficiaries of the pandemic, you know, maybe a work from home technology or what have you, they probably didn't benefit as much and were you know, not prioritized. What happened when that when the pandemic happened is existing investors sort of made sure their existing portfolio companies were okay and were maybe not doing so many new deals for a while. And it took a while for everyone to sort of pick up their heads and look, you know, look elsewhere. And so if you're not well known, I think if you didn't get a chance to establish a lot, you know, good network, particularly for the early stage companies, it was a bit tougher for a few months for sure. And hopefully as we're seeing things open up, that's changing. And certainly events like this and this week help a lot. But I think it was tough for some early stage companies for a while.
Yeah, that is what we did see in the Angel Forum as well. Like a lot of focus from the investors went to their existing sort of portfolio companies, but then it picked up again. Is that something you've been seeing in sort of the venture side of things as well, Christina?
Yeah, absolutely. You know, I think there's certainly a lot of frothiness right now in terms of money getting raised and the associated valuations. One of our peers at another firm pointed out this morning that I think the average valuation for a Series A is now 50 million, and 10 years ago it was 9.
Yeah, wow. I'll quote you on that, yes.
Well, I think it was from another report, and so you know, you hear that and you think, gosh, my nose is bleeding, I'm up so high, how on earth are we going to deal with that? And so I think in the near term, there's certainly an inclination from the entrepreneur side to go for the highest valuation possible. But the challenge is really not right now. It's the next round of funding. And what will the market be like when you do your next round? And that's the thing that I think people are losing sight of a little bit right now with these valuations is the CEOs see these big numbers, and even some of their investors see the big numbers and they think, oh, great, that means my company is worth, FUBAR. Well, the challenge is that in order for you to continue on that same trajectory, the market has to be as good, if not better, in your next round of funding. And so, best case scenario, in 18 months, when you go and do your next round of funding, we've got the same market. That's best case, because this is kind of crazy right now. And so most likely case is that the market's going to come down a little bit and it's going to normalize, because venture, you always see these ebbs and flows of valuations. And when you're sitting in the common seat and the CEO seat going after these great big valuations now, the next round might not be as good, or it might be a flat round, despite the fact that you put in another 1.5 years of incredibly hard work. And that dilution is coming out of common. That dilution is coming out of the entrepreneurs and the founders, as well as existing investors. And so the part that's hard to coach people through right now, because some folks just don't want to hear it, is don't go for the highest valuation. Go for the partner you want on your board. Go for the business partner you want to have behind you, pushing and bringing value to your company and helping you out, and the network you want to tap into and the experience you want to tap into. Don't just go for the highest number, because that's going to bite you in 18, 24 months when you're going out for your next round and trying to justify an uptick in your last valuation that you got during extremely frothy times. And so that's really what we're seeing right now, is a lot of hard conversations people don't want to have, because it's right now, it's good time, Charlie. Let's get the big numbers while we can. But I think we're going to have very different discussions in the next 18 to 24 months.
Yeah, we have those same discussions, and it's almost like falling for the sort of glitchy suitor in his big, car driving you off to wonderful, or just stick with the true and tried, who will be there in sort of less sort of great times. So yeah, no, we're very familiar with those discussions. Peter and James, you've done some things together. Can you, James, can you add to this sort of description of the situation and what may lay ahead?
Yeah, I guess Peter and I were more early stage early than Maria and Christina. So I think there's pre-seed, from what I see, still continues to be really hard to finance. A lot of work for the companies. Maybe a little bit less than a couple years ago, but I think all this chat about the frothy markets, some of the pre-seed companies get weird expectations, and or they're making decisions like, oh, I got to go big now because I don't know when this is going to end, or they're thinking, they read like TechCrunch and like all that stuff, and so I think it's actually kind of negative for a bunch of pre-seed companies, because they just have sort of unrealistic expectations. And then as a investor, you are a little bit conflicted. I'm trying to say like this is sort of reality. But yeah, so sometimes just timing wise, like they'll I got to do a round now and have some big valuation just because they're thinking about the market. But also with like a Series A, they're a lot bigger now, but it is kind of like, in terms of metrics and expectations of the company, it is a lot later stage. So I'd say like seed round 1s and 2s are kind of like the Series A's of 10 years ago. But I'm a fan of safes for myself, maybe contrary to Peter, because I like getting involved in the companies, rolling up my sleeves, helping out, but I'm pretty bad when it comes to like the numbers and the terms and all the legal stuff and working through all that. That's to have that, figure all that out early on is a lot of work. And I want someone like a really smart person like Christina or Maria to figure it all out. And then I can benefit, but I can invest early. So that's kind of where I've sort of landed on safes recently, but there's weird things of like safes, and then there's like the next safes and the next safes. So then you're not like converting to, and sometimes some of your terms you've added in, information rights, pro rata conversion, etc. The next safe knocks those out, and you want to be a nice, generous investor, so you go along with it too. So there's a lot of things to consider, but yeah, the frothiness I think is more like at the seed and beyond, and not really too much the pre-seed stage.
Thanks, Jim. Peter, do you see that money that's coming out sort of like with sort of the higher level financings, sort of the exits, do you see it come back like at the earlier stage?
Yeah, although I cannot sort of say, like, if you have an exit, how much is actually cycled back into startup opportunities. But we see a lot, we've seen some exits last year, and that some of that money that has floated back into early stage companies, and you see that happening most of the time. But you also got to give it some time. Look, when you have an exit, you take a break, you take a review of the landscape before you actively start investing again. In particular, in an environment, as we just said, where the valuations are quite high. I mean, it's not an unusual strategy to say, well, I'm going to set aside a chunk of cash for when the contraction comes, right? And Christine referred to like 18-24 months, and I'm with her in that thinking. You got to get some money. You're going to set it aside for when that contraction is there, and when prices will come down, and you can invest in companies at a much lower valuation than is the case today. So it's all a question of careful portfolio management. But to answer the question, yeah, we see money circling back, and it's generally good news. What I've also seen is quite a few exits of deals that I'm involved in, where the M&A activity got stuck for COVID-related reasons or other reasons, and a number of things are on hold because of that.
Yeah, exactly, because we don't always read about that. It's like you only read about those sort of overnight successes that we all know maybe do not exist. I give you a chance to James mentioned that you might be less of a fan of safes. Is there anything you want to say to that?
Yeah, I'm less of a fan of safe. Well, the problem with safes is, the safes that we're seeing in Canada today are very different from the original safe that came out of Y Combinator 7-8 years ago. So there's sort of a Canadian version out there which has all sorts of bells and whistles, which makes it a bit more palatable to investors. Like, for instance, with eFund, we've invested in a medical device company which has a safe, and it had an 18-month conversion date at a relatively low valuation. So the company had to sort of ensure it's going to do a venture financing or Series A financing, and then it would convert. But if it doesn't do that by that date, then it would convert at a low level. And my point is, well, why don't we do just common shares from the get-go at a fixed valuation? Because I like to know what I own in a company. I also like to have voting rights, which is a safe. You don't have any voting rights. You're lucky to get some information rights. So I like to have some influence either at the board level and or as a shareholder. And if you're a common shareholder or a preferred shareholder, you have that by law anyways, but especially if you're a preferred shareholder, you can negotiate certain voting rights or board rights that give you a bit more a seat at the table. So that's and I don't like situations where well the market will change and the conversion through safe does not take place. You may get your money back, as Brent has alluded to, over a number of years, but in the meantime you're just sitting there and you're not sure what the value is of what you're holding. So it's hard to value. Even if you run a portfolio, it makes it hard to put a value on it, and there's no clear there's no clarity. So the uncertainty of it, I don't like all that much. So what I do is sort of, if entrepreneurs start talking about safes, I say, well, these are the downsides, these are the pros, so let's have a discussion about it. But we can also do common or preferred structures, and you can have input in that, right? I encourage entrepreneurs to think through how they see the funding cycle and what they want to see before investors push something on them, and come up with creative term sheets or deal structures as sort of a preparation, as sort of an exercise before you start talking to investors.
Thank you. Prentice, you just mentioned something about how the founder can prepare for this, just run through the cap table. Is there sort of a certain thing you would advise investors to do? I know you're more sort of, if I may say, on the founder side, because that's what you do, but is there sort of more legal advice you would have for investors as well?
I think they just have to go through the same almost the same process, and that might be working with the company to go through those what if scenarios. Peter's bringing up good points just in terms of, again, what is this instrument? You don't get to vote. You're sort of sitting there until someone decides for you that you're going to get a product or a share that you really have no negotiation about what it's going to include, and you're handed it. It's that's what it is. And at best, information rights. And I referred to the SAFE having a standard form, and it is, so long as there aren't any other bells and whistles added to it, like Peter's talked about, conversions at a certain time or the like. So it's the investor needs to understand just the same. And James makes a good point. Again, he's happy to invest on a SAFE and let the others sort of pave the way. And that's there's two schools of thoughts. Is it good? Is it bad? It just depends on how you view it and what the circumstances are. So there you go.
Yep. As always, the truth is somewhere in the middle. Yes, Maria.
I just wanted to add one point on safes, and I think it's a bit of a trend for a while now, and we'll probably see more of it. This was also brought up by a peer this morning, where a Series A venture term sheet will have post-money valuation versus pre-money. So that puts the onus on the company and the company's lawyer, Prentice, to figure out all the mechanics of the cap table. But the VC is like, this is too complex, especially if there's layers of safes, and just say, for 20%, my $3 million buys 20%, you figure it out, kind of thing.
Yeah, I think just generally speaking, jumping on Maria's comment there, there are good companies that attract good investment dollars, and then there are maybe good stories or the like, but are more difficult to fund. And so that's when we tend to find these convertible notes and safes and other things, because no one's really sure. And it's not that it's bad investments, it's just that it's a tougher sell. So you start adding all these bells and whistles and adding these complications, and unfortunately it starts getting expensive, because guys like me have to sort of work it through and make sure it's right, and it all seems well and good to get that money in the company, but there's a cost of capital beyond its face value. There's all sorts of time and effort and understanding that is required when you get layers of safes, or even just the one layer of safe itself. So yeah, it's just something to keep in mind, that you can get overthinking and over complex in a hurry without really understanding what the consequences are.
Yeah. Then on a sort of other note, it's not really another note, but Angel Forum always, we at Angel Forum really stress, it's the whole investing process is a process of the building of relationships. Do you trust someone? Can you work with a founder? And it really actually comes down on trust. And I think it's always said, in bad times, we ride the wave together, but in good times, I think we should ride the wave together too, because there's always sort of a downturn coming. That's the cycle of life, I would say. So can you speak to that? How do you like to work with a founder or with an entrepreneur, with a company? Christina, you've been an entrepreneur yourself, right? So you can talk about both sides, actually.
Yeah. So I don't know if it's through luck or stupidity. I've been on both sides of the table, and it's been a
Celebrate it.
And it's really interesting prior to doing a startup, I was on the investment side, did a startup, went back to the investment side. And it's interesting. I've got a lot more empathy this time around.
Yeah.
And I view things very differently. When I was doing my company, what I was looking for in a board. I had been on boards that were good, bad, and ugly, and everything in between. And the thing that really stood out to me was that great investors can really elevate a company, and unsophisticated investors can really drag it down with things that are just not stage appropriate, not company appropriate. You know, you might have great people who are experts in their field that are asking too much of a company given their stage. And so when I was constructing my board, I remember being very deliberate about who I reached out to. So if you look at the ecosystem of investors, there's folks that focus on your industry, folks that focus at your stage, and then the folks that you want to work with. And by the time you filter down to that, you've got a very small list of people, and you reach out to them, and then you diligence them as much as you diligence anybody. But the things that I was looking for were, number one, someone who is going to be an extension of the team. Someone who's going to get behind me and the company and the vision and push and be a resource and get out there and hustle as much as I was, and help me be in conversations I couldn't be in, help me find people I couldn't get access to, you know, kick open doors and really be an extension of us. And so that was really, you know, my number two criteria. Number one was obviously culture fit and someone I wanted to work with. Number two is an extension of the team. And then three was really a strategic sounding board. So, you know, here's problem XYZ. I think this is how I address it. What do you think? You know, give me your feedback and play devil's advocate, and just being that really great business partner. And it's interesting, having gone through that phase and gone through all of the, you know, challenges and everything that comes with building a company and taking it through acquisition. I really value the role of a board member a lot more than I did certainly the first time I was in this seat. Before, I thought it was, you know, go be a resource and help. But now I'm realizing, like, the board member you want is in the trenches with you, and they're getting mucky up to their elbows. And certainly at an early stage, you need that. Because once you're at that stage where you're later and you've got all of your key roles filled in, you've got your operational metrics sorted out, you need more of a financial partner and a scale partner. But in the early days, you really need somebody who's got that DNA to get in there and really help and bring creative ideas to the fore, bring creative people to the fore, bring creative solutions, and help you. And so I think, you know, looking at it from both sides, when we look at companies, we look at it as a partnership. It's not a, you know, obviously we're there for governance and checks and balances as well, but it's really a partnership that we're engaging in with the CEO and with the founding team to say, okay, where do you need help? Where can we help augment the skills that you're bringing to the table? And being really honest about where the strengths and weaknesses of the founders are, so that we can go and bring those resources in and help lift them up and get behind them and make them successful. Because if they're successful, the company's successful. And if the company's successful, we're successful. And so it's really about finding those gaps and figuring out how do we help build them in and lift them up.
Absolutely. And I think someone who's really good at that is James. But that's my opinion, James. Can you talk a little bit about how you work with founders and why?
Yeah, so probably like Christina, I have a lot of sympathy or empathy. I'm not sure what the right word is for founders. So in Victoria, Victoria's not a big city. There's a lot of software deals in Victoria. And so I'm one of the few people, there's a few other guys like Sean Jameson and I can't remember other people's names, but we kind of get intro to software companies quite early through Viatech. And then just kind of like a series of meetings and discussions, because they're quite early, we get to understand them. We have something we call Victoria Vipers. So it's for an early stage company, they can apply to a Viper session, and it's kind of, we give them 1 to 2 hours of unfiltered, constructive, trying to be like positive, but feedback on what they're doing. But at a certain point, we kind of end up as like soft investors, but then we will want to get on the company's Slack. We have like a private advisors channel. We see all the stuff. We like to do a monthly advisors meeting kind of mid of the month to like review all the KPIs and financials and all the business discussions and stuff like that. And we have sort of like a bit of a program of of how we take like kind of crazy couple founders, cool market, cool tech, but get them to be kind of seed stage investor ready. So there's yeah, a few of us in Victoria that kind of do that. So I really enjoy it. That's kind of my day job is Zoom and Slack and working with Victoria startups. So
Yes, and we're very happy that you do that. Thanks, James. Peter, I think that's your approach as well. Slightly little different, but yeah.
Well, I've been championing working with founders over a prolonged period of time before you get to the investment phase. And a lot of founders and entrepreneurs come to me and say, Peter, can I talk to you, or I need money, and you get to know them and you meet with them, or you have a coffee with them, or you go out for dinner with them, and they become people that you get to know. You develop a relationship, and through that relationship, you get to see what they're good at and what they're not so good at, and where they need help. And when it comes to the point in time that there's a clear need for money, where the company is ready for money, you know them, and you can say, okay, well, we can make the investment decision, and I have no hesitation in sort of introducing you to my network, right? Because you talked about trust, and it's also, and we've done a number of deals over the past 2 years where people looked at me and a few others in my network, James among them, is like, well, are these founders okay? You've worked with them, you know them, right? So building that trust relationship over a period of time is incredibly important, and will reap big rewards. And I've mentioned before, a number of these entrepreneurs have become good friends. They sold their company, they had an exit, and they come back to you, and that's a lifetime relationship. And it needs to start early, right? So, and I always encourage for the entrepreneurs on this call is to sort of reach out. I get emails and LinkedIn invites nonstop, and sometimes it's a bit much, but I know which ones I think are worthwhile to pursuing, and I'm always happy to have a chat and to initiate that relationship and to build something that in the end can lead to a fruitful investment relationship and building a successful company. So yes, it's key, and it's the formula that we approach at Angel Forum and some of the other venues that I'm involved with, is building those strong relationships between founders and investors, because we all want to do the same thing. We want to build successful companies, and we also want to have fun doing it, right? It hasn't been mentioned yet. It's got to be fun, right? It's not all numbers and stress and market share. We've got to build a pleasant experience while we're doing this.
Yes, we do, because indeed a few of those have become friends, and that's because of the fun part. Also, what I want to mention for the people on the call, like as a founder, and I think Christina and James might agree with that, you don't have to know everything. It's like there's people that can help you with things, but be very honest about what you're good at and what you may be not so good at. And you don't have to be all things to all people. And the same with the approach to investors. You do due diligence on them as well. Is there, Peter, are there a few questions that you have for the panel?
No, I'm just curious what, in general, what they're seeing in terms of valuations and deal flow at the moment that we speak, right? Because we're in this crisis now for like 15 months. So I see some patterns, right? First, we started to close deals that we knew from before COVID started. Now we're closing deals and investing in people that we've never met in person. And I see an incredible amount of software deals coming through. Not all of them that I think are fundable, but they're interesting nevertheless. I just want to sort of see what you see at Pender, what you see in Victoria that is worth mentioning, and talk a little bit about the valuation trends and if they are reflective of the market in general.
Maria?
Sure, I can add a few things there. So you're totally right, Peter. We initially, our first deal actually right after COVID was a company we'd been already talking to for a year or so. So that was easier, and it was hard for a while to do new deals and get used to the new world. But now all the term sheets we have actually out are, folks that we, for the most part, haven't met in person at the very least yet. But we got there. So for sure, I think the pace and number of deals is accelerating, which is good. A big theme for us is health tech. So we're seeing a lot more. And we're so thankful that it sort of accelerated a lot of the technology adoption And so we're seeing a lot more deal flow in that area. A lot, you know, where it's software as a medical device kind of area. You'll have to hear all this, James, I'm sure. A long time coming. A lot of the early work that you did at Genealogics is coming to light. So seeing a lot in that area as well. And seeing a lot more cross-border activity picking up again. It had slowed initially, and now it's sort of picking up again for sure. Valuations, I think we've said that enough. It's certainly high and getting higher. We are though seeing where, you know, the valuation is a sticking point. Term sheets with bells and whistles, as you would expect, and some investors can't quite get there. And that's unfortunate because those terms tend to come back and haunt the company later on. So we're seeing a little bit of that. So I don't know if that's an early indication of some valuation changing, hard to say. And then the final point I just wanted to make was on the exit side, and you mentioned this in one of your slides, Peter, you know, it's a good time to be an entrepreneur running a great company that's, you know, later stage. I would say every single one of our portfolio companies is either in discussions for a financing in M&A or even considering IPO. And I'm not sure, you know, all three of those options were available to private tech companies at the same time for a long time. And I'm not sure they will be options for the rest of my career anyways. So it's good. And, you know, I think it's really good to see that even in Canada, technology companies can go public now in a much more concrete fashion with supportive public market investors. So that it's nice to have options and to allow entrepreneurs to sort of think bigger, which we often get accused of in Canada for not being so. So that's certainly a trend we're seeing with later stage companies.
There's one thing I'll add to that we've been, you know, Pender, we've been paying pretty close attention to because it's impacting our ecosystem here. You know, for years, larger companies have been setting up offices, certainly in Vancouver, to tap into the engineering talent. And now in kind of the COVID forward era, with people realizing that they can get access to high quality talent for cheaper in non-traditional locations, it's doing a couple of things. Number one, it's driving greater capital efficiency, and we're seeing more and more companies pop up that have got really distributed teams, like almost entirely distributed teams. But you know, my concern, just based on what I'm starting to hear of Bay Area companies, is I'm getting asked a lot about setting up an office in Vancouver to tap into the talent here. And it's now not just the big companies that can afford, you know, the lawyers to do it. Now there's a lot of folks looking at shops that will set up offices here for you, hire the talent for you, take those employees on for you, and then you can issue options via them. There's a lot more of that starting to happen, and a lot more questions are coming my way. And so that's the other thing that I'm kind of keeping my eye on, is how many of those Bay Area firms that would have paid $200 to $250K a year to a full stack dev straight out of university that can now hire that same person for 120 Canadian in Vancouver. And, you know, how are they going after that talent, and how's that going to impact our talent pool here and the cost of capital here? And then what's it going to do to team distribution for companies based here? And so that's the other thing that we're just kind of keeping our eye on, is how is this impacting cost of capital and talent?
Very fair. I think that's on a lot of people's mind as well. Like, Prentice, is there anything that you sort of want to point to?
Well, not sure. I do have a question though, which is,
no, we love questions.
which just in terms of the frothiness and the valuations going up, are we catching up to those California valuations, or are they going up even more? So, I mean, you know, we've always been, from our corner of the world, you know, got clients all the time saying, you know, oh, I know somebody that went down to Silicon Valley and this is the valuation, and why don't I get that type of thing up here? You know, are we even remotely close, or are they still, you know, way ahead of us?
Well,
Christina.
I think there's probably people with way more data than I have. I purely have anecdotes, and there's some great online resources around kind of mean, median, range on valuations. I think Cooley actually has a great one. But anecdotally, we're nowhere near the valley. I think it's just crazy the salaries being what they are down there, they have to raise so much more money to do the same amount of work that the valuations have to fit in order for the cap table to work out for the founders. And so I think just given the cost of people right now, I mean, obviously things are starting to get more dispersed. But again, anecdotally, what I've been seeing from the Bay is a lot higher than what it is here. But, you know, even here, and I would kind of clump the Pacific Northwest as a group, it's certainly rising. Like what we've been seeing in Seattle is starting to get quite high.
Thanks, Peter.
Well, I was waiting for James to sort of respond
Yeah.
to my point.
I want
James?
you to go first, and then I can take the counterpoint.
And then they muted themselves. There you go. So I'll
I forgot
fill.
the question too.
You go, James.
Oh, okay. Yeah, I think it was what am I sort of seeing? I think there's just over the next 5 years, there's just going to be more and more and more software startups, and there's like all these new business models, all these new like enabling technologies. So like AI is the good example. Anything big decision making, AI is gonna either be like a direct company or a major feature set for some other companies. But all this like direct to consumer, all these different niche software as a service, like kind of anything as a service. I recently invested into this InsurTech as a service. So they're a platform and allowing all these other companies to provide insurance through APIs to there's like just all this new video and collaboration. There's just going to be so much disruption in the next 5 years in all these different ways. So I think there's just going to be more and more startups. That's kind of what I'm seeing across the board. Yeah, that's I guess that's kind of my take.
Okay, Peter. Thanks, James.
Do you see any companies that are being chased by a group of investors and then they sort of disappear south across the border, or they get away with a valuation that's not realistic?
Yeah. There's been some companies in Victoria that I thought were really great, but have had a bit of a more difficult time raising like a seed or a Series A. And then there's been other ones that I've been like, oh, I guess they have a whole different investment thesis than I do, and some value investors come up and like do like 40 million on a 200 pre or like stuff. And I was like, what? Like 4 years ago, I could have got in at this valuation and I passed on it, and like all sorts of interesting stuff. So yeah, so I am definitely Canadian. I'm kind of like bottom up, like the founders trust, grit, like and help them grow, as opposed to like some thesis and like I kind of want all my companies to do well. I don't want to like have that one hit wonder that makes the portfolio. So and I think a lot of Canadians are that way as well. So yeah, but it is interesting what happens in Silicon Valley. But I used to like go down there fairly often, and almost every year there was like a big theme. It was like for a while it was like as an example, there was like, what's your local deals strategy? And then the next year it was like, what's your mobile first strategy? And next is like, what's your consumer enterprise strategy? And like, there's all this like group think down there as well. So yeah, but it's kind of interesting. It's Silicon Valley is not the tech capital of the world, but it's the tech financing capital of the world. There's just so much money down there, and they can just make crazy bets without. That's why they like safes. And it's like they love it down there. I'll throw some money at these 50 different kind of ideas without even doing much due diligence. So I've seen Silicon Valley investors make decisions in 3 or 4 days, what the investors up here would probably take a month of like looking at this and looking at that and stuff. So yeah, it's a totally different world down there.
And that is okay. There's a reason why Peter and I, as Dutch people, feel at home here, I think. Just the step-by-step approach.
In Vancouver? You feel at home in Vancouver?
I feel at home in Victoria and Vancouver. Peter, I think maybe we could just close off with just one thing that we want the audience to keep in mind for the months to come. I just want to say, I think these are very exciting times for the pluses and the minuses, but stuff is happening and that's great. It's not boring, which I really appreciate. So shall we go around the room and just for that one sort of statement, what you want people to keep in mind? Peter, do you want to start it off?
My advice would be for investors and entrepreneurs would be the same thing, is get some good independent advice, right? Reach out. We've got these ecosystems. We are here. Just ask around, and before you sign a term sheet, before you do a deal, just poke around and talk to other people. Advice is free. A lot of people are willing to give advice. Use it to get to a better decision for your company or your investment.
Thank you. Francis?
Thanks, Irene. Yeah, I would, along that same line, you know, I got the privilege to speak about safes today, and you know, I think that overwhelmingly there's a misunderstanding or a lack of understanding about not just what they are, but what the impacts are. So, you know, I echo Peter's comment is, you know, study, learn, understand, because it can, you know, you don't want to be stuck in these weird places of either paying too much for guys like me to sort stuff out, or worse, you know, almost like a penal dilutive result. So understand and take the time, and as Peter said, talk to the network and understand.
Thank you, Prentice. Maria?
Yeah, so I think for, well, really both investors and entrepreneurs, think about how you actually want to lean in after this crisis. Some of the best companies get started during these times and can figure out how to come through. In fact, you know, if a team has survived and thrived, that's a very good point of diligence on both sides, right? So, you know, so think about how that could impact your growth plans and therefore your financing plans.
Yep, very wise advice. Christina?
I think keep a focus on the long term. Maria mentioned earlier that one of the companies she'd invested in, she'd known for a year in advance. You know, that's a comfortable period of time for us. And so, you know, my advice is get to know your investors early. You're more than married when you take money from someone. It's easier to get divorced than it is to get rid of an investor. So spend your time doing your diligence, get to know your investors, get to know the folks around the table, and really focus on what that long-term relationship and business relationship is going to be like, because it's definitely going to be one of the most impactful relationships in your life, not just in your business. And so really keep an eye on the long term.
Yeah, and the untangling of not so great relationships business-wise are expensive and take a lot of time and energy. You can be better spent on something else. James?
Yeah, I think my advice to founders is kind of know how investable you are, or like play that your actual hand and not like a blog post that you read. So I think there's like when you can't get financed for a particular round and when you can, but there's this sort of messy middle. And it is, if you can, it's best to not finance then, but move to be in a nice place where you get the right investors, the right terms they want. Like, so if you can, don't invest in this middle place where it's going to be a ton of work. You're not going to get the right investors. And Christina made this point earlier on, like, yeah, prioritize the people part of the equation and not just the numbers and the terms as well. So, I mean, I guess I'm super biased, but I like to think I provide good value to the companies that I work with, and the other people I work with do the same. So, for getting the right investors, you can have access to networks, to partners, to employees, to other investors, plus a lot of experience and a lot of pattern recognition from other startups that they're working with. So you can get a ton of value out of the right early investors. So.
And who do you want to be with in good and bad times, right? Who has your back? I think that's pretty important too. Peter, is there anything you want to add to this?
No, I'm curious
Good.
to see what the audience thinks.
Yeah, there's, I'm just toggling between, there's a question about what the current rate for safe caps is for startups that are generating some revenue with pre-profit. That's hard to say, right? I think we would need more for that. So I can only take questions from the audience if they type it in the platform chat or Q&A space. Okay, there's no particular question that I think needs answering right now. So I think this is a good time to thank everyone for the contribution. James, Peter, Prentice, Maria, Christina, I would like to have a beer with you because I think we can just talk about this for a long time, way longer. So thank you so much for agreeing to join us today. I hope it was useful. I really enjoyed it and I hope the audience did as well. Good luck to the Vancouver Startup Week. There's awesome programming for the rest of the day and the week. So go and have a look. That's it for Angel Forum today. We hope to see you at one of our events. The website is angelforum.org. Again, big thank you to all the people, James, Peter, Prentice, Maria, Christina.